structured today's talk around three big questions. First of all, the strategy. What should the strategy be for M&A, and what are some of the strategic considerations? Secondly, the deals. What do the transactions look like? What are expectations? What works? What doesn't work? And then finally, arguably the most important, is the post-deal execution. How can we improve the situation such that 80% of M&A deals actually succeed instead of fail? So I'm going to start with Antonio, actually, and just invite you to talk a little bit about Stefanini's strategy around M&A and some of the experience you have around that.
Right. We started our discussions about M&A actually in 2008. So till then, we grew basically organically only. The idea was basically found our strategy in two main pillars, right? One was expand to geographically, right? So enhance our global footprint, and another pillar was to complement, to find companies and solutions that can be complementary to our offering.
Why did you choose M&A as a strategy over organic growth?
Well, because when you reach a certain stage and you want to be global, you can do that to speed up your growth, right? And as I said, it's very important also to complement and making sure that we're going to leverage, different experiences from different regions. And to be a true global company, you need to be able to mix, cultures, right? And M&A is a great way to learn that.
Well, in our case, we started as a very small company, and as we began to grow regionally, that is with Central American clients, we foresaw that the opportunity lied abroad, and we decided that we needed to work on three different stages. First of all, enhance our performance through processes. Secondly, strengthen our IT infrastructure, and third was to acquire the know-how for taking of larger clients. So we started that process in 2007. In 2011, we thought we were already ready and did our first acquisition in Canada. We recently, last year, did our second acquisition in the United States, a company in Des Moines, Iowa. And it was a little bit awkward. How can a Latin American company, especially from Central America, can come to the United States and do an acquisition? Culturally, I think it's one of the first experiences that I've heard. Now I'm listening to Antonio's, but it was a challenge. And we understood that we needed to acquire talent. We are in the service providing, and our major asset is people. And that's our most important pillar is our people, our agents. They are the ones that provide the work.
The first thing I want to address is when you look at this space and look at going into M&A, you have to decide what your motivations are. In the three M&As that we did, each time it was motivated by different stimuli. In the first case, we're looking at a straight buyout, which post-acquisition execution means that you just make sure that the processes can remain in place or can be absorbed into the existing system. The second one, which was a joint venture, was strategic alliance for access to markets. What we found was that we were hitting the wall in terms of access to clients in North America, and so we decided to enter into the joint venture, which worked very well for us, so that we could have access to existing client lists, but beyond that also immediate credibility. In associating yourself with an international brand as we did, we immediately got credibility in the space. And the third one was driven by scale. I think this is the hardest one to cope with, certainly in terms of the implications for the organization, because we had scaled to a size of 4,500 employees. And despite great profitability and everything, we simply couldn't carry it to the next level. which was taken from the $75, $80 million company to a $150 million company without significant debt acquisition. So as partners, we agreed, let's step away from this. And that's actually the most difficult one to do because there is no real strategy around except knowing that you simply can't go beyond where you are. So I think the most important thing from the sell side at the outset is to define what you're looking for. Ensure that you stay true to that ideal, because beyond that, the post-transaction execution will fall down and won't achieve either party's objectives.
So I think it's important to first understand some of the market fundamentals. So first, if you compare the Latin America region and the outsourcing market there, it's roughly, as of 2014, anticipated to be about $35 billion. And you compare that to the Indian market, which is about $100 billion or so, okay? What you see here is a market dynamic which is really not comparable, not just in terms of size, but Latin America also is not a contiguous state, okay? And that means that the opportunities for integrating and working together and creating economies of scale are limited. So when we think about Latin America, we think about strategic opportunities, but they are very regionalized. Okay, so sometimes we group everybody into this, sort of Latin America region, which includes the Caribbean and Brazil and whatnot. But it's really a series of countries. So understanding that and then sort of overlaying the M&A aspect. So what's happening? Well, one, automation is happening, right? So where we know Latin America is very strong, particularly is in language-based support, BPO, not so much in the ITO area, and that's really due to the dearth and availability of technological skill sets. As we see automation increase in the region, just as Mr. Wadhwa said this morning, Vivek mentioned, we will see those jobs begin to erode. The global providers, which include the historic Indian providers, are shrinking, or maybe not shrinking, but certainly their growth is slowing. They will continue growing through acquisition, which is essentially going to destroy the local market in many of your smaller countries, which means that they're going to acquire competitors, smaller players, which in 5 years will likely not exist.
Recent survey results show that really the number one factor for doing M&A deals is the amount of cash sitting on the balance sheet, followed by the desire to expand into emerging markets. And the same survey showed that 77% of deals are actually less than $250 million in transaction value.
If you consider that the first things that are really important to measure that success is retaining the clients and the key people in the company, right? So the integration, it takes a while. It's not only doing the project plan and the due diligence and main integration of the process. It's a constant work to do. Having said that, we had some surprises in terms of investments that we didn't have predicted that we would need after the acquisition, right, to make that happen, that deal work. So some of them, it took longer to have the return, much more than we expected. Another aspect also is that when you have the ownership of the company that you acquire coming to work with you, it's very delicate, and you have to be really careful to not just restrain them, right, and give a certain level of autonomy inside the parameters that you need for the future.
Well, I think these M&A deals fail for the same reason that outsourcing transactions fail. And they fail ultimately because of misalignment of expectations between the buyer and the contract and the service provider and what they're delivering. And that hasn't changed. That hasn't changed in 15 years, and it won't change. So, how do we get better deals? I think that's the fundamental question. Well, we've moved to different types of sourcing governance models, which are all driven out of the same kind of transaction. What is the transaction? Well, some people call them outsourcing, some people call them M&A, but it's essentially a divestiture of a scope of work or of services which is provided for by the customer. Maybe it's in a captive center, maybe it's in-house, maybe it's in North America, maybe it's not, it really doesn't matter from a business perspective. that service is divested to some service provider to manage. Maybe they pay an acquisition fee for it, maybe they don't. Maybe they get their fees in kind through services and returning services back. But ultimately, I think as the rest of the panelists have already said, the way that this really works is ensuring cultural alignment, ensuring very strong governance, and making sure that we have a strong project management office that continues the alignment to the contract, the change order management process, and the like. And this is something which is sort of sourcing 101, and I think all of you know. But the best deals out there are those deals that remain flexible, that can change and move with the changing needs of the customer. And those tend to be very relationship-driven deals.
I would say to anyone who's looking at this sphere is that if you just want to sell capacity, if that's your sole thing, well, then that approach to the development of the organization will work. It's fine. People come and buy your capacity. But if you want a true valuation of the enterprise, one which recognizes the culture of the organization and the skills of the organization and processes of the organization, we have to build a brand around that and set your expectations of performance and success around that.
How do you ensure success around implementation and execution?
We have to have a very clear strategy, right? And the governance that you mentioned before, is very important. And one thing that I value a lot, since we do acquisitions in different regions and countries, is that the culture, we have to respect the culture of the company, the region, right? But at the same time, making sure that you are going to be able to keep the values of the company that are acquiring, because after all, we cannot be a bunch of companies working under the same name. We have to be one company, right? And that is a very important that we start working since the beginning. And one of the things that make that or help that happens is the communication.
Even the acquiring firm has some potential risk because of the cultural change that occurs when new blood comes in. And so it's very important to have a very strong communication and message, but it's also very important to get the detractors out of the way.
Specifically for IT outsourcing, are there any countries you'd like to call out as being the first set of targets if one were to look at, not at acquisitions, but at merger targets?
Mexico is becoming more attractive to us today, more attractive than it has been. One, because of its scale and size. Similarly, Brazil has been historically very attractive to us as well, but the challenge there, of course, is a heavily regulated environment and tax regime. So on the flip side, when you look at it, it's really, I think, a targeting exercise. If Zensar, for example, or any services company is looking to make an acquisition similar to the one Convergys made, I think that you really have to focus on the company that you're acquiring, their geographic footprint and skills-based training program, and how they're actually pulling from key universities and skilling up in the local markets. Because if you look at Latin America-based companies, the ones that are most successful, they are spanning across more than one country. And in some case, it's 1 to 2 or 2 to 3 countries. And they already have the supply model for how they're drawing candidates and talent into the company.